Hello, clients and friends. It's Monday, April 13th, and I'm giving our quarterly update here titled Perspective, Patience, and a Plan. This is Barry Mendelson, certified financial planner, wealth advisor, and managing partner here at ZRC Wealth Management. I hope everyone had a wonderful Passover, Good Friday, and Easter Sunday. Beautiful weather has returned here to Northern California, so hopefully you found some perspective and some comfort in springtime weather, whether you're here in California or someplace else across the country and the globe. Let me dive into some slides. We're pretty upbeat about things as there have been some really positive developments across the country, some what we think are some green shoots that are going to soon lift, or at least in the next month or so, lift the sheltering in place and resume our normal activity and normal daily and economic activity. So I think we all know the hit to the financial markets over the last quarter. U.S. stocks were down 20%. International stocks were down more. Real estate investment trusts and real estate stocks were down even more, as a lot of small businesses had come forth and said they were going to stop making rent payments, and tenants are stopped making rent payments as well. So a lot of uncertainty around real estate, some of which you as real estate owners and landlords are experiencing yourself. So we know we're going to get through that episode with real estate. As we would expect in a sharp downturn like we experienced last quarter, U.S. bonds and global bonds as a whole were a great ballast. The single best hedge in a downturn, as we expected, and no truer was last quarter when they held up. Looking back over the last year, stocks had across the board are down, and over the last 5 years, international are now flat to negative as well. So a tough couple of years. Now we're seeing stock levels had taken away, stock prices had taken away what the great gains we'd experienced in 2018. As we know, 2019, effectively the markets were kind of flat to negative. So now stock prices and stock valuations are where they were back at the beginning of 2018, if not late 2017. And again, fixed income, that great hedge in your portfolio, is really still there, performing as we would expect, and has got a little boost of the last year as the Fed here in the United States has cut interest rates back down to historic levels, which has boosted the prices of bonds. Longer term, things still look pretty good. As you'll see in a second, what we believe has happened, or what we are experiencing, is really the end of the current cycle, the end of the greatest bull market that we've experienced for the last 11 years, and the new chapter is unfolding. And what we want to make sure is that you guys are well positioned to take advantage of that when the market does begin to recover and things resume to normal. One thing that we'd seen, and this is a chart from our friends at Blackrock, looking back over the last 70 years, going back to 1950, pretty remarkable. Here, 3 of the most volatile days in the last 70 years occurred in March. 3 of the most volatile weeks of the last 70 years occurred in February and March. And what we know is that there is a lot of uncertainty, and investors and the market doesn't like uncertainty. There are a lot of unknowns out there. And so that is what is causing the sell-off, is because as humans, we are having difficulty computing that there's going to be an end to this crisis. What we do know is there going to be an end, and that the market is going to recover. The economy is going to recover. We can see that there's going to be a light at the end of the tunnel, even if we can't see that light today. And what we know is that after periods of extreme volatility like we've experienced, on average, the market does recover. It does bounce and recover quite quickly. You can see on average, 1 year after the most extreme days, up 24%. Not in every instance, but in many of them. After the worst weeks, markets returned up 14%, and over the worst months, up about 16%. So right now, as I record this, the market's down from its February 19th peak by about 20%. At one point, it was down in the middle, towards the end of March, it was down about 33%. So it's come back a significant amount since then. We don't know if we're at a bottom. We think actually there, as more economic data gets digested, the market could decline further. But whether it does or whether we're at a bottom, what we do know is that if we go out a year or longer, it increases the likelihood that the markets will be higher. And that's why it's so critical to stay disciplined with your investment plan that we've put together for you guys. This just looks at some of the headlines over the last year. Everything was trucking right along. And then again, February 19th came along. And as developments started to emerge out of Wuhan, China, we saw the virus and the effects of it spread in Italy and other parts of the country. The stock market, global stock market as a whole, really practically fell off a cliff. That said, we can look over here at the last 20 years, and it has been an incredible run. Historically, what we know is that the stock market declines about 20%. We have a pullback like 20%, like we've experienced so far, about once out of every 5 years. Yet, if we look over the last 20 years, we had, this includes the dot-com bust here in 2000, the financial crisis, which was the second greatest bear market we'd experienced in the U.S. stock market's history from 2007 to 2009. And yet, despite the fall off over the last 2 months, over the last 20 years, it's still been a great run. And even, we look over the last 15 years, 13 years, still an amazing run in here. So for any of you that are viewing this, we know overwhelmingly your time horizon is 10 plus years. This is to be expected, and that at some point, and we think sooner rather than later, your portfolios will recover. We'll be back to a phase where we're in an expansion economy and expansion market. This is one of our favorite charts from JP Morgan that we've illustrated a lot with you guys over the past. And again, just shows the fourth quarter that really, again, stocks fell off a cliff. As we had prepared you guys really for the last several years, we knew this was going to happen, right? We knew the market moves in cycles. We just didn't know. We knew it was going to be something nobody knew or had any suspicion or any idea it was going to be a global pandemic that would shut down the economy. But you guys were prepared for this. We had ample fixed income, and analyzed and understood your cash flow needs, so that you could withstand a downturn like this. Stocks are certainly a lot cheaper, obviously, than they were just 2 months ago. So on the bright side, stocks are more attractive. The Fed has cut interest rates, which we know has always been supportive of recovery and stock market performance. So we know it's just a matter of time before stocks begin to take off. As we share with all of you, certainly stocks are cheap, but they're not, and they're not back of the truck cheap. They're not March 2009 cheap, where it's obvious that we should go all in. The information about the economy hasn't been quite restarted yet, and we know that it's going to take some time for the economy to recover. We don't think it's going to be, we call it a V-shaped recovery. We think it's going to be kind of a slow, gradual recovery, what we often describe as a U-shaped recovery. So as we've explained to all of you, we have already once rebalanced client portfolios, and those stocks are certainly cheap now. We're being patient and vigilant in how we are rebalancing client portfolios again. So we haven't made that second rebalancing. We're really kind of taking our time to understand some key fundamentals and understand opportunities clients have to take advantage of the CARES Act, to understand your individual cash flows before we go back and rebalance again. So that is something we're intending on doing, but it would not be unprecedented for the stocks to decline further from here. We don't have a crystal ball, but if that's the case, again, you can be patient and disciplined through this. It ends up just presenting more opportunities for astute investors. This is a chart from our friends at First Trust, and I think it's really great from a lot of different levels. One is it overlays the performance of the S&P 500, again, looking back over the last 70 years, going back to 1950. And it shows the drawdown for each year, how much at one point the S&P 500 was down each one of those years. On average, the drawdown was 13.4%, meaning you had at some point, on average, the market declined every single year about 13.5%. Here we have 2009, where it declined actually about from peak to trough about 50%, was pretty remarkable. Now, I love the perspective that we get. I've been in this business nearly 25 years now. I went to go work for Franklin Resources straight out of college. I was in their institutional asset management arm. Went to go work for them in July 1995, 3 weeks after graduating from UC Santa Barbara. Was there for a couple years. Then in 1997, I went to go work for Neuberger Berman, a 100-year-old value-based asset manager out of New York. I worked in their San Francisco office, and a couple of years later, I went to work for a company based in Orinda called AXA Rosenberg, a big quant equity manager. And during that time was the dot-com boom, where you had companies that were going public that really had no no business even being in business, much less having their shares listed on a public exchange. But yet that was the period that we were in, and there weren't the listing requirements that there are today, where there wasn't the Sarbanes-Oxley requirements and accounting standards that there were today. And it was so obvious to us in the business at Neuberger and at AXA that there would be a reconciling, that companies like Pets.com, Global Crossing, Webvan, um, all of which are no longer in existence, that they would not survive, that they had no near-term earnings prospects, and there would have to be a reconciling. And sure enough, there was when recession hit and these companies ran out of money. So I mean, we could see that there was a disconnect, something fundamentally wrong in the financial markets. We just didn't know when it would be reconciled. And it was just a natural part of the ebb and flow of the economy. Then in 2004, I went to go work for Charles Schwab Investment Management, $200 billion plus asset manager. And I was there during the financial crisis. And I remember, 2007, 2008, I was upstairs at our fixed income desk with the managers of our bond funds. And again, we knew, so there was something fundamentally wrong in the fixed income markets. People were selling what seemed to be high quality securities. There was deleveraging. We knew that there was a reconciling that was coming, and but we just couldn't quite put our finger on it. And this is just, again, another example of kind of the ebb and flows that you would expect in the financial markets as they work out some of the kinks in the system. As we knew that the market moves in cycles, as I began to work with all of you over the last decade, we knew that there was going to be, again, some sort of extraneous event that would impact the financial markets. No one, obviously, in their wildest minds would ever think it would be a global pandemic. So, we didn't know what the cause was, but we now are living and experiencing the effect, right? We're all sheltered in place. Small and large businesses alike are being affected. Business owners, who I ask you to have great patience and respect for, especially small business owners, are having to furlough, cut employees, not make rent payments, not make service provider payments. Really a challenging time. So we know what the effects are. We didn't know what the cause was, but we know we're going to get out of this. We know there's an end date, and we know the economy is going to work out of it slowly but surely. An example of that is another chart from our friends at Blackrock, again, going back to 1950, shows every bear market since the 1950s. Here we had that bear market, that 19.8 decline we experienced from September to December back in 2018. Here we've got the financial crisis. Before that, dot-com bust in 1998. This was the Asian contagion currency crisis, long-term capital management. 92 was the healthcare real estate crisis. 87 was Black Monday, so on and so forth. You can see the extent of the decline of the stock market, what it took to get back up to break-even levels, days from low back up to that break-even level, and the returns 1, 3, and 5, and 10 years afterwards. And in every instance, obviously, once you've hit those lows, everything is peachy from there on. Again, we don't know if we're at the low right now or if the low is yet to come. Maybe it's behind us. But what I do know is if you can hang on, and we can help you hang on. You're going to get through this. You're going to get through this. That if you can hang on, it's going to be rosy afterwards. Okay. That's where discipline, perspective, patience are required. Okay, so hang in there. One thing we've heard from some of our clients is, I don't have, excuse me, I don't have years to wait for the market to recover. But one, you do have years, and two, it's not going to take years. Here is using the financial crisis as an example. So again, the market peaked back in October 2007. We're using the S&P 500 as an example, and it was a very ferocious bear market. The stock market declined more than 50% in 15 months. So bottomed here in March 2009. And if you are in a 60-40 portfolio, which many of you are, right? 60% stocks, 40% bonds, okay? Here you are, March 2009 from when it bottomed. You recovered back up by October 2010. That was 21 months from bottom, okay, to top, 21 months, less than 2 years. If we're there, or if we're near there, again, it's only been 2 months since the market peaked. Hopefully we're back up there in 1 year, 2 years, 3 years, or less. And even, this is an extreme example. Hopefully the market doesn't experience a 50+% downturn. Right now we're at about 20%. But even during this extreme period, the second worst financial crisis in U.S. history, from peak to peak in a 64 portfolio, 3 years. You've got 3 years. You can do this. You have the resources to get through this. We will be there for you to make sure you do. Let's talk about planning opportunities. It has been overwhelming for us, certified financial planners, personal financial officers, as we often describe ourselves, as one of your trusted advisors, the CPAs that you work with, the attorneys that you work with, the bankers that you work with. We are all overwhelmed. And the government is absolutely doing the right thing. The Fed cutting interest rates, Congress, the president, the administration, having instituted 3 different economic measures to support people who need it the most, and especially small business owners, people with 500 employees or less. These are the people we are most concerned about. Landlords and real estate owners, a wide swath to which is you who are watching this video right now. So hang in there. These measures, and if, I'm sure you're versed in, and if not, contact us and we'll try to help you determine what is you're eligible for and what can make the most sense. You need to take advantage of. We want to make sure you have every resource available to you to withstand this downturn and be in a position to take advantage of it when you come out the other end. We talked about the Secure Act that came out of several months ago. A lot of it is probably obsolete right now. Now we're looking at the CARES Act, and there has been 3 stimulus packages. Would not be surprised if there's not a 4th, if not more than that, to help businesses here. Many of you, or some of you, are getting stimulus checks. If you file your taxes or receive Social Security, you'll receive that automatically if you're eligible. If you don't do either one of those, and I can't think any of our clients that fall in that camp, but you can go onto the IRS website and apply for it there. Other resources that you have available to you as an employer are the Payroll Protection Program, also the Economic Injury Disaster Loans. Other planning opportunities, you can, which we are spending a lot of our time evaluating for those of you that might be eligible or could benefit from it. We're evaluating these so that we can then follow up with you, explain to you what your options might be, what the tax implications are. There very likely for many of you are going to be some real opportunities to save a lot in taxes this year. So we are analyzing these very closely for you so that we have a plan around this and you can take advantage of these. 2020 is going to, if we play this right, is going to present some really significant planning and saving strategies for your clients. One of those is to skip RMDs, opportunity for Roth conversions, which is an even more complicated financial calculation and planning opportunity. We talked about payroll relief for small businesses. And many of you are landlords, own rental properties. And landlords are supposed to be eligible for both the PPP and EIDL based on lost rents. The language around that's confusing. If you're not already in contact with your CPA, you should be. If you need to be put in contact with a CPA who's knowledgeable about this, we can certainly help you with that. Lastly, which I'll talk about in a second, is now is the time to revisit your financial plan. Log into it on our website or Money Guide Pro, who's the cloud-based financial planning software that we use. If you're having concerns or an anxiety, or maybe your goals and priorities have changed, go back and log into, and let us know that you want us to do that, so we can change the login page. Make sure you guys log into the right area. Go in and review what your expectations are now that you're retired, or when you want to retire. A lot of us have been at home, all of us have been at home and had discussions with our loved ones and spouses, and a recentering of what our priorities and values are. Now is a great time to look at this and see if things have changed for you. Likewise, think about concerns that you have: not having a paycheck, not having rental income, caring for a loved one. What if your kids have to move in with you? These are real concerns that can be flushed out and addressed and actually factored into your financial plan. So you want to revisit these in your financial plan. Let us know. We'll make sure that you land on this page. Another thing to do is review your net worth. Again, this is articulated in your financial plan. To the extent that you've shared this information with us, to the extent that it's already captured in there, this is a great opportunity to take inventory of the assets that you have, whether it be the equity in your home, your investment accounts, collectibles, things like that. These all have a place in supporting your short, intermediate, long-term goals. If you're a business owner and you're thinking, hey, where can I tap capital? Do I need a home equity line of credit? Things like that. We can certainly advise you on it. I've had it as a business owner myself. I own ZRC Wealth Management. Have looked at the opportunity of, hey, do I get a small business loan through my bank, or do I do a home equity line of credit? And overwhelmingly, the home equity line of credits have lower interest rates, and at least for me, better terms to finance parts of the business and make investments where necessary. So you don't always have to go through your business bank. We can help you be creative with ways that you can tap assets, even a margin loan against your investment account at Schwab. So worthwhile to revisit your net worth, understand the resources that you have. For a lot of you, and again, we're reaching out as fast as we can, as thoughtfully as we can, to reconnect with you. For a lot of you, we've reviewed your financial plan and said, okay, let's look at the last 2 months and see what has happened, and has that affected your plan? And I can tell you, in not a single case where we've had these review calls, and many of you are watching this right now, has it affected? Does it change one iota, one thing in your financial plan? 2 months does not make a difference. Even the stock market declining 20% or more does not make a difference in your long-term financial goals or plan. And we knew something like this was going to happen. It was factored in there. You've got the resources. Let us show you. Let us remind you how it'll work. I've covered a lot today. What we want to make sure is you guys are feeling comfortable about where you are financially. We're here to be a resource. If something's on your mind, we'd love hearing from you. We're doing our best to be proactive and reach out to you with all the planning opportunities and updates as we can. We ourselves at ZRC are already preparing for the next chapter. We know some financial services firms are getting a struggle through this, and I want to make sure that as the owner of ZRC, that we have the capital to make some strategic hires, because there are probably going to be some really good people that are going to be on the market that would make great additions to ZRC and help us expertly serve you. So we ourselves are already thinking about, how can we protect the capital that we have, so we come out of this even better than when we've entered. But we want you guys to hang in there, stay strong, support your local businesses. Kristen and I are getting takeout from all of our local favorite restaurants. We feel terrible for the downturn that they've experienced, and we want them to survive through this. And so be sympathetic to your local business owners. And even the professional service firms, our CPA friends, our local IT technology friends, many of which know that they're performing services for clients that they're probably not going to ever be paid on. That's the right thing to do. Let's all band together to help get through this crisis, which we will. And lastly, the disclosure from the attorneys. Thanks for the time today. Keep your chin up, and wish you and your families the very best.